Bond yields are soaring to 3-month highs on the latest red hot inflation report. The Fed has a major inflation problem, but they are going to cut anyway. Fiscal dominance has arrived in full force at the expense of the dollar. So the global sovereign debt market is not doing very well. That includes here in the US, where the 30-year government bond yield is soaring to a 3-month high of 4.8% on this latest PCE report. Now, what is PCE? This is the Fed's preferred way of measuring inflation. Remember, there's PPI, CPI, and then PCE, which is personal consumption expenditures. Remember that the number you hear reported on the nightly news when it comes to inflation is an annual rate of change of an underlying index. This is that underlying index. This is actually how normal people experience inflation, which is a cumulative rise in prices. That is what we can see from CPI or PCE. Both of them show that cumulative rise in prices, not the annual rate of change. That is not how normal people feel inflation. By the way, if you take what people are actually spending per person, that is up by 39% over the past 5 years. Now, official government inflation data would tell you that inflation has been 22% over the past 5 years. Now, doing this measurement does not account for an increase in volume. So you might be spending 39% more than 5 years ago, but if you're buying more stuff, then you have to adjust for that. I would just say I don't know a single person that is able to afford more volume than they were 5 years ago. 39% is just an absolute horrendous loss of purchasing power. 40% loss of purchasing power is unacceptable. The Fed is going to cut interest rates anyway. In fact, they already have. As we know, they are in a rate cutting cycle. Now, here's that annual rate of change that you will hear reported on the nightly news. Core PCE strips out food and energy, which are much more volatile. PCE includes the headline figure. PCE includes those much more volatile food and energy components, but both of these measures are running much closer to 3% than they are to 2%. Why does 2% matter? That is the Fed's inflation target. They have a dual mandate of full employment and stable prices. Now, for some reason, the way they interpret stable prices is 2% loss of purchasing power each and every year. We are 50% almost above that 2% target. Now, here we're taking that core PCE annual rate of change, the annual rate at which prices are going up. As we could see from the second chart here, prices are almost always going up. The only question is, how fast are they going up? Well, here we're taking that rate of change, the degree to which prices are going up, and we're subtracting the Fed's target of 2. And what we see is that we have been above the Fed's target for 56 months. Anything in red here shows inflation, core PCE, which is above the Fed's target. Anything in green, like after 2008, is below. Inflation is below the Fed's target. In fact, after the GFC, they were actually trying to stimulate inflation. By the way, over the past 3 years, inflation has averaged 140 basis points above the Fed's 2% target. Now, here we're looking at personal income. This was also released as part of the data release this morning. Right now, growing at a 5% annual rate of change. Now, PCE, actual personal consumption expenditures, is growing at 5% as well. Remember, personal income is a very broad way of measuring income. It includes things like interest and dividends and investment income that the lower leg of the K, the bottom 90% of Americans, do not have. They have the average hourly wage. Well, if we look there, that is only growing at a 4% annual rate of change. And as you can see from the green line, we have been below the rate of inflation. The average hourly wage growth on an annual basis has been below the annual rate of change of PCE, or those personal consumption expenditures. So again, personal income being a much more broad way of measuring income, we can see that that is much, much different from the average hourly wage, that annual rate of change of the average hourly wage. Now, what is going on in markets? Well, bond yields continue to soar. Again, not just here in the US, all around the world. We can see that S&P 500 did gap up higher today. We faded that on the live stream, did pretty well. We see VIX looks like it's probably ready to move higher. Bitcoin is selling off. Gold was popping at first, is giving some of that back. And of course, the 2-year, 10-year, and 30-year are all up in terms of yield. Now, remember, the yield is inverse to the bond price. So when you have higher yields, that is a lower bond price. With the 30-year, you have to go back 3 months to see the last time that the 30-year yield was at 4.8%. So bonds are not liking this report, even though it did come in below the market's expectation. There's probably some amount of recognition starting to trickle in with gold getting bid and, of course, bond yields higher, dollar down. There's probably some amount of recognition that we are entering, if not already there, in fiscal dominance, where the Fed is not acting in the best interest of inflation. They are acting in the best interest of that $1 trillion interest expense, $1.2 trillion interest expense that is just soaring. It is growing at a 27% annual rate of change, as we saw yesterday from the monthly Treasury statement. Now, here's a look at the yield curve. We have seen a steepening, meaning the gap or the difference between the 30-year, a long duration bond yield, and the 2-year, which is a much shorter duration bond, and of course, reflects what the Fed is going to do much more than the 30-year. The 30-year, you are worried about inflation. You are worried about deficits. You are worried about bond supply. That is where term premium gets priced in. The 2-year is you're worried about what the Fed is going to do. So the pink line shows the difference. How much premium are you getting for taking that duration risk? Right now, we are only at 1.2% more yield on the 30-year. This was probably going to steepen. We are seeing a bear steepener over the past couple days, meaning that the difference is growing, as we can see from the pink line, but is not growing in a bullish way for bonds. Yields are soaring. They are just soaring the most at the long end of the yield curve. Now, to take a look at Japan, their bond market is not doing too well either. Here's kind of a long-term look going all the way back to the early 2010s. Here's a shorter-term look, and what we can see is that even at the short end, so we know the 30-year has been soaring in terms of yield. Remember that the bond price is inverse to the yield, so bonds have been selling off quite aggressively over in Japan. But recently, we are starting to get the 2-year yield up as well. And the belly of the curve, the 5-year, those bond yields are soaring to multi-decade highs on the expectation that the Bank of Japan might actually hike interest rates. Now, of course, for many decades, they were in the what they call the lost decades, a very, very poor economic growth outlook. They had negative interest rates on the overnight rate, and they had yield curve control, QE, all of that. Well, bond yield soaring means that capital that didn't want to be invested in a 0% yielding 10-year might start to come back home. Now, remember, that would involve selling of U.S. Treasuries, selling of the dollar, the buying of the yen, and then buying of the JGB. So eventually, there's going to be an equilibrium point where the long end in Japan starts to stabilize, but it will drag U.S. bond yields higher due to that capital repatriation. Now, remember, Japan has been a very large current account surplus country for many years. They run a very, very large trade surplus, so they're a creditor to the rest of the world. They run a capital and financial account deficit, or they are a creditor to the rest of the world. Now, the DXY dollar index, I mentioned fiscal dominance and the Fed no longer acting in the best interest of inflation and the purchasing power of the currency. Well, you would not expect the currency to do too well. Here we're looking at kind of a short-term view of the dollar going back to the end of November. Kevin Hassett, obviously a tool, a stooge from this administration has been floated in a trial balloon sort of way as the next Fed chair. And we have seen the dollar weaken substantially. We have seen the bond market weaken substantially, meaning a bond price down, yields up. That is exactly what you would expect to see in a concern, a capital flight out of a country if the investors were worried about fiscal dominance. Because of course you can get interest rates very low. You can run negative real rates where inflation is above the cost of your debt, but it comes at the expense of your currency. And that is what we are starting to see in the DXY dollar index. Anyways, hopefully that was helpful, and I'll catch you in the next one.